Yeah, I'm losing my edge.
Using historical data to trade, Pete, the market we're going to look at today is interest rates. And it's interesting because interest rates are probably, correct me if I'm wrong, one of the most mean reverting markets that are out there. And we'll dip into what that means here in a second. When I came out of college, I started trading at the Board of Trade. And now we were trading interest rate spreads, but it was a similar idea where everybody was modeling, everybody on my desk there was modeling these trades off of the fact that markets in interest rates tend to mean revert, at least more so than equities. And I want to apply some historical data to this and look at how historical data can drive trades in a few different time horizons. I mean, aside from volatility of equities, Pete, I think the 10-year interest rate's got to be the most mean reverting asset class. Am I wrong? Just tell me if I'm wrong. Don't be nice about it.
No, I don't know if you're right or wrong. I think for me, the dollar would be the most mean reverting asset classes. Yeah, mean reverting is all function of, I mean, what time frame are you talking about? So my first choice would be FX, but a close second would be rates. So there's my 2 cents on that.
Jeez,
well, let's take a look and see what the data tells us.
Yeah, we get have
an existential discussion about that
question to Liz and Jenny or anyone else on the network. They would have been like, ba 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 ba, good back and forth, and you're like, I don't know, maybe foreign exchange. This is why I have more fun with my other friends. But small yield.
If I can only move you over there on a full-time basis, it's not even my birthday.
Small yield, Pete, has rose to highs unseen since early 2020. And so the market looks kind of expensive, right? But you rope in those early 2020 prices and prices from even beyond there, as we will in a second. You start to apply more historical data, and the story looks a little bit different. And I want to just dig into this. But first, what's really nice is I love talking about this product because it's so friggin' simple. Right? Like $10, 1%. Right. You think that they're going to 2%. Liz and Jenny did the classic, back in my day, they were 3 and 4%, which you have done ad nauseum. If you want to do it again right now, like what was the 10-year rate back in 1940 and 1950 when you were a kid?
Oh my gosh.
Is that funny? I don't.
Well, yeah, because I have no idea what the 10-year rate was in 1940 or 50. I know when I started to trade, the short rates got up to 19 or 21%. So
that's not true. Really?
Oh yeah, 90-day T-bills were, I think they were getting either between 18 and 19%. Yeah, I mean, it's so funny, and it just is. It's interesting. You talk about mean reversion in context. I remember at that rate, mortgages were every bit of 20%. And guys were thinking, boy, if mortgages ever fall to 12%, I'm going to borrow all the money in the world because it is so cheap to borrow money at 12%, where I would easily sell you to get 3% on my T-bonds right now. So
yeah, and that's interesting, and that's the other side of it. That in my lifetime we haven't seen, which is rates abnormally above their average. Yeah, when you were at 20%, that's insane. You'd be looking at this historical context that we're looking at today and probably saying, this thing's got to come down. And it did. And now the conversation is less like, oh, man, these rates are so high. The next stop is 25, 30%. Who even knows how high they can go? Now it's become a conversation of how low they can go, as we've seen 10-year debt elsewhere below 0%.
Can I change my answer? I agree with you. Interest rates are the greatest mean reverting product. I honestly, I just had to walk through to my mind around trading the zero interest rate bound. And yes, do they stay at zero for an incredibly long period of time? They certainly have.
Sure.
If we want to say 5% is our mean for the last 30 years, which I think would be a fair statement to make, to trade 18% and zero and them stick there for a long period of time. But I agree with you. I think in context, you're absolutely right. So I take my answer back, agree with you. Is that enough back and forth? Are you excited now? Can we move forward?
Are you doing this?
No, I agree with you.
Is our CFO, Matt, just telling you to do this?
No, he actually told me that, again, your friend rent is past due, and he doesn't want to have to garnish your wages.
I'm going to have to start paying to work my job. That's insane with this friend rent from you and our CFO.
I like you're thinking ahead. That's what I want. Is thinking ahead.
Let's think ahead.
Speaking of thinking ahead.
Yeah, let's think ahead to the projected high and low for this week here in interest rates. And you can see S10Y has moved through its projected high. And this is just a little bit of a short-term exercise when looking at interest rates and mean reversion. And, Pete, I have a feeling you're going to be less confident in that answer when it comes to short-term rates and where they're capable of going. But that being said, maybe I'm wrong, because this is the foundation for a lot of our scalping strategies without, whether you know it or not, is like, okay, on Monday, the projected range via realized volatility in this product is 11 and a quarter and 9 3/4. And when we saw that market jump up to 11 and a half and even higher this week in S10Y, you're looking at potential short positions so that it does mean revert back into the range on the short term. It's the same thing. We're talking about decades worth of data. It's the same thing when you're looking at 5 days worth of data, right?
Absolutely. Same basic concept, just a different time horizon. So, and it's funny because one of the great things about the simplicity of this product is the clarity of being able to look at that range and realize that in terms of an interesting tradable product, for $1,000 notional, for it to move 30 or 35 ticks as a percentage of the underlying, it's a very interesting product. I don't want to say it's more leverage. It's leverage like every other future, but the opportunity to trade a small notional like this that has movement is really very, 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 very engaging. So when we look at this and you think, well, we're at 1147 or 1144, that's only, 21 ticks away from that 5-day range. We're rolling into Friday. Are we past it? You know what? That's an appreciably bit past it, considering we have a day and a half left.
No, great point, because yes, the margin from the small exchange, the initial margin on this product is about $180. So if you were to sell those 1150s or wherever the market is and bank on this mean reverting coming back into the range in the next, day and a half of trading here, Pete, even if you make $20 or $30, that's a good return on that low margin. And yeah, this is a market where the realized volatility in here currently is at about 20, 30, even 40% at some periods. So it is kind of like a lot of people like trading those small stocks that are in the 10 to 20 or $30 range with an implied volatility that's, 20 to 40%. It's very similar to that. The nice thing is that it's a diversified trade, has different movement than those equity markets here, and the short-term scalping opportunities that come along with it. As we see here yesterday, intraday, a lot of back and forth, just like Pete is saying, 20, 30, 40 cents here. And usually, Pete, now this is when we start to talk about how historical data can employ new trade ideas. In the short term, when we're looking at the 5-day forecast, or we're looking at standard deviations and mean reversion around that in the short term, it's usually futures alone, right? That's your scalping vehicle. If you're trying to get something done by the end of today or by the end of this week, you have no problem just going to those S10Y futures and being like, all right, I'm short. I've got my mechanics for, I'm closing this thing. I'm short the 1150s. I'm going to try to take a profit at 1110 or 1120. I'm going to take a loss at 1180 or 1190. And you're usually just going straight to the futures, right?
Absolutely. For a quick directional trade like that, absolutely. We've actually used, options premium when there's been a huge expansion of volatility, and sometimes used far out of the money puts and calls to give us a little bit of that reflexive movement if an underlying just stops moving or actually reverts a little bit. But in terms of what we're talking about right now, this is the most efficient way to go ahead and do that and actually be able to employ your strategy. Sometimes, you could be right selling a call, but if that market does hold in place, but vol expands, you're not, there is more variables in place than this pure binary decision here of being either right or wrong. And that's where, for those quicker decisions, trading around this type of back and forth, futures are the natural place to go to, in my mind.
Absolutely. And that's a great practical way to view it. And also, this is roping in today's topic, which is, if I'm looking for, it's Thursday afternoon, if I'm looking for an opportunity, a short-term opportunity by the close of today's trading or the close of the week's trading tomorrow, then I'm only using historical data, Pete, that goes back the last week, the last couple of weeks, right? There's no point if you're going to look at this market and you're going to say to yourself, well, a year ago, 2 years ago, the 10-year was up at 3%. So this product has been as high as $30. So I'm not getting anywhere near shorting this for the next couple of minutes or hours. You can't use that much historical data when you're talking about a short-term opportunity. Where
Absolutely.
you can use this much data, and I did you one better. I went all the way back to the 90s to look at the average 10-year yield since the 90s, since the aughts, and since 2010s here. And that's always a fun one, isn't it? But you can see here that this kind of positions us for a potential long trade. But like we talked about this a little bit yesterday, and I talked about this with Liz and Jenny. When you're looking at different time horizons and scalping, that's using historical data. Like I said, the last couple of days and weeks, looking at that range, looking at standard deviations, and seeing some mean reversion there. If I'm looking to maybe buy or sell S10Y to have a position for the next 30 days, the next 60 days, maybe all of 2021 here, I'm using more data and I'm saying, okay, well, this is a market that got as low as $5 or 50 basis points, 0.5%. And that was the low for decades, Pete. And now we're seeing this kind of back on the upswing. I like the idea of this market getting back to, in the long term, at least, this 2%, maybe even that 3% long-term average. That's mean reversion, Pete, in the short term and the long term here, right?
Absolutely. And I think we always talk about this of trading both sides of the market here. And in terms of reasonable reversion, absolutely. Do we get to 2.5% as in the same way that we came down from $1.90? I don't think so. You never know. But the idea of this is part of the way we build bias. And what I think we've done, and a lot of what you've built has been good in talking about having a long-term bias here, a bullish bias. And what's nice with this product, as you mentioned, just means I think yields are going higher. Okay, there's no inverse knucklehead dealings. So I can have a long-term bullish bias while a short-term bearish one, and they're not conflicting. And that's empowering yourself with a lot of different opportunities, and that's really important. But I like what you're talking about in terms of looking at the perspective here helps us determine strategies and biases, and then looking at mechanics around them. So, and you know what? I'm so glad you went to TBT, because this is the natural piece. A lot of times we talk about pairs that are, because of negative correlation, are long, short, short, and those are tough pairs to understand. So walk us through how we better understand a pairs trade and rates here, Frankie.
Well, yeah, and this is, to me, until we get options on the small exchange, which are very, very soon here. This is, to me, just like a covered call. Yes, it is a pairs trade because you're going across products. But now I'm changing up my strategy now that I have this longer time horizon, and it's a different trade than that short-term short using historical data of the last couple of weeks. I'm using more historical data. I'm looking on beyond the next couple hours to the next couple of weeks and potentially months. And I loved the way that Liz and Jenny posed this, which is, looking at one short call in TBT. Don't start with me. One short call in TBT here against one S10Y contract. They looked at it the same as they talk to people about reducing cost basis on a stock position. If you buy a stock at $30 and you sell a call and you roll that call on into perpetuity, eventually, if you're getting $1.50 every time you sell that call, eventually you will own that stock close to $0. I like this idea lent to the interest rate market here, where I buy this S10Y contract. I look at, an out of the money call in TBT ranging from, you're not going to get a bunch of money, but ranging from, 30 to 50 or 60 cents. And I do that in February, I do that in March, I do that in April and on into the future. And now I've got myself a long-term S10Y contract. I'm banking on the mean reversion getting back to normal. Like you said, it doesn't even have to get back to 2.5% or 3% or 4% here. Just in the year of 2021, getting back to 1.5%, which would be $15, or getting close to 2, that's a nice chunk of change for my S10Y contract. And selling the calls all the while, Pete, can get me long this market from even lower. And that's employing this historical data, whether you're trading in the short term or the long term.